Welcome to the video. Today we will dismantle the myth that maximizing your 401k makes an IRA unnecessary or overkill. Even if you are hitting very high contribution levels through employer plans, profit sharing, or after-tax contributions, an IRA remains a critical tool. We will cover the logic, the tax diversification benefits, a recommended savings hierarchy, and practical steps to optimize your path to financial independence. Here is the agenda. First, we will set the context and challenge the overkill myth. Next, we will talk through the recommended savings hierarchy. Then we will explore the IRA's essential role and discuss tax buckets and flexibility. After that, we will cover specific advantages for early retirees, walk through a step-by-step plan, test your understanding with short quizzes, and conclude with key takeaways. The context is that some people can reach very high 401k contribution totals through robust employer plans, including profit sharing and after-tax contributions that enable Mega Backdoor Roth strategies. Although that is impressive, it does not remove the value of an IRA. In fact, skipping an IRA can reduce your tax diversification and flexibility later. We will explain how these pieces fit together and why the IRA remains essential. This content is for educational purposes only and should not be considered financial, tax, or legal advice. Everyone's situation is unique. Please consult a qualified professional who can provide advice tailored to your circumstances and current laws and limits. Let's debunk the overkill myth. The claim that maxing a 401k eliminates the need for an IRA is not accurate. Savings targets should be based on your desired timeline for financial independence, often at least 15% of income, rather than solely on IRS contribution limits. Moreover, tax-advantaged accounts are generally superior to taxable brokerage for long-term compounding and control over future taxes. IRAs, especially Roth IRAs, add a critical layer of tax diversification and flexibility that you cannot replicate by using only a 401k. Here is the recommended order. First, contribute enough to your 401k to capture the full employer match, because that is effectively a guaranteed return. Second, fully fund an IRA. If you can deduct a traditional IRA, that may be best. Otherwise, consider a Roth IRA, often via the backdoor method for high earners. Third, go back and maximize any remaining 401k space. Finally, invest excess savings in a taxable brokerage account. The flowchart shows these decision points and how backdoor Roth may fit for high earners. Let's compare. The 401k's strengths include high contribution ceilings, potential employer matching, payroll automation, and in some plans, after-tax contributions with Mega Backdoor Roth capabilities. The IRA's strengths include the Roth IRA's tax-free growth and withdrawals, generally broader investment choice, flexibility for early retirees through access to Roth contributions, and access to a backdoor Roth pathway for high earners who are phased out of direct Roth contributions. These accounts are complementary rather than substitutes. The IRA plays several essential roles. First, it provides tax diversification, complementing tax-deferred 401k balances with the tax-free future of a Roth IRA. Second, it enables strategic withdrawals in retirement, helping you manage taxable income to stay in lower brackets. Third, it is friendly to early retirees, because you can withdraw Roth IRA contributions at any time without tax or penalty, creating a bridge before age 59.5. Finally, Roth IRAs may provide additional flexibility for long-term planning and estate considerations. This pie chart illustrates a simple example of tax diversification across three buckets: tax-deferred accounts, such as 401k and traditional IRAs, Roth accounts, and taxable brokerage. The example proportions are 50% tax-deferred, 35% in Roth, and 15% in taxable. The precise allocation should be tailored to your plan and tax outlook, but the objective is to create flexibility so that future withdrawals can be managed tax efficiently. Here are the action steps. First, estimate your financial independence target and aim to save at least 15% of income. Second, capture your full 401k employer match. Third, open and fund an IRA using a deductible traditional IRA if eligible. Otherwise, consider a Roth IRA, potentially via the backdoor method. Fourth, return to the 401k to maximize remaining room. Fifth, if your plan allows, evaluate after-tax contributions and the Mega Backdoor Roth process. Sixth, invest excess funds in a taxable brokerage account. Finally, repeat annually, rebalance, and review your tax bracket projections. This table summarizes the recommended order. Step 1. Contribute to the 401k to receive the full employer match. Step 2. Fully fund an IRA, either traditional if deductible or Roth, possibly via backdoor for high earners. Step 3. Maximize remaining 401k contributions, considering plan features, fees, and whether to use Roth or pre-tax contributions. Step 4. Use a taxable brokerage account for overflow savings, where you can also practice tax loss harvesting and manage capital gains. Quiz time. The question is, if you have already maximized your 401k contributions, is skipping an IRA a good idea? Option A. Yes, because more 401k means you do not need tax diversification. Option B. No, because an IRA, especially a Roth IRA, adds tax flexibility and early access options. Option C. Yes, because taxable brokerage is always better than tax-advantaged accounts. Option D. It does not matter either way. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is no, because an IRA, especially a Roth IRA, adds tax flexibility and early access options. A Roth IRA offers tax-free growth, tax-free withdrawals, and access to contributions at any time, which complements a 401k and enhances your tax planning options. Roth IRAs are especially valuable for early retirees. Your Roth contributions can be withdrawn at any time without tax or penalty, creating a liquidity bridge before age 59.5. This can be coordinated with Roth conversion ladders and plan-specific rules, such as the Rule of 55 in certain employer plans. The additional flexibility can help reduce sequence of returns risk during the early years of retirement. This timeline illustrates a multi-stage approach to early retirement. First, during the initial years, focus on capturing the 401k match, funding the IRA annually, and investing any surplus. Next, as you accumulate assets, consider backdoor Roth contributions and model a Roth conversion ladder. Upon early retirement, you can use Roth IRA contributions as a bridge. In the mid-50s, evaluate whether your plan allows the Rule of 55. Finally, at age 59.5, you gain full penalty-free access to tax-deferred accounts. Here is a quick recap using Markdown emphasis. First, prioritize tax-advantaged accounts before taxable brokerage. Second, remember that a backdoor Roth is a process, not a special account type. Third, be aware of the pro rata rule for backdoor Roth conversions, as well as plan fees and the timing of rollovers. Finally, the overarching goal is to maintain multiple tax buckets for future flexibility. Second quiz. The question is, what is the recommended order of savings for most workers? Option A. Maximize the 401k entirely, then use taxable, then fund the IRA. Option B. Use taxable first, then get the 401k match, then fund the IRA. Option C. Contribute to the 401k to get the full match, then fully fund an IRA, then return to finish the 401k, and finally use taxable. Option D. Fund the IRA first, then taxable, then the 401k match. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is to contribute to the 401k to get the full employer match, then fully fund an IRA, then return to the 401k to finish maximizing contributions, and finally use a taxable account for any remaining savings. This sequence captures match dollars, builds tax diversification early, and maximizes tax-advantaged space before moving to taxable investing. These are the key takeaways. First, maximizing a 401k does not make an IRA unnecessary. Roth flexibility is extremely valuable. Second, diversify across tax buckets to control your future taxes. Third, follow the recommended savings hierarchy to accelerate your path to financial independence. Fourth, use backdoor strategies when appropriate and avoid leaving tax-advantaged space unused. Finally, review your approach annually, including plan rules, fees, and your projected tax brackets. To summarize, a 401k and an IRA work together, not as substitutes. A Roth IRA enables tax-free growth and access to contributions, which is useful for both traditional and early retirees. The recommended order is to capture your 401k match, fully fund an IRA, finish maximizing the 401k, and then use taxable accounts. By diversifying your tax buckets now, you gain flexibility for future planning and potential tax savings. Thank you for watching. If this video helped you reassess the overkill myth and refine your saving strategy, please like the video, share it with someone who might benefit, and subscribe for more content. Tell us in the comments how you structure your tax buckets and what questions you want answered next.